All right, welcome. In this explainer, we are diving straight into the very heart of accounting. We're going to break down the 5 fundamental elements that make up any financial statement.
Hey everyone, welcome back to the Audit Guidebook channel. This is Module 5 of our accounting series, and we're so glad you're joining us. Let's jump right in. So, have you ever wondered what the fundamental building blocks of a company's financial story really are? Think of them like financial DNA, the unique code that tells us absolutely everything about its health and its performance. Well, the official accounting standards give us the answer. These elements are basically the universal language of business. They're how we take everything a company does, all its economic activities, and translate it into a clear, structured financial report that anyone can understand.
Okay, so let's start with the absolute foundation, the bedrock of any company's value, what it actually owns.
And that brings us to our very first element, an asset. So what is it? It's any resource the company controls that's expected to bring in some kind of future economic benefit. But here's the key takeaway, the one thing to remember. An asset is simply what the business owns.
To make this super clear, think about things like cash sitting in the bank or inventory stacked up in a warehouse. Even the money that customers owe the company, which we call accounts receivable, that's an asset. And of course, the physical stuff like buildings and vehicles, they all count. All of these are assets.
All right, now let's flip to the other side of the coin, because if we understand what a business owns, it's just as important to look at what it owes.
And that leads us straight to our second element, a liability. A liability is a present obligation, something you have to do right now, to give up resources to someone else because of something that happened in the past. But really, the simplest way to think about it is this. A liability is what the business owes.
You see these all the time. We're talking about things like bank loans or unpaid bills from suppliers, what accountants call trade payables. Even expenses that the company has racked up but hasn't paid for yet, we call those accrued expenses.
And this right here really shows that fundamental balance perfectly. On one side, you've got your assets, everything you own, and on the other, your liabilities, everything you owe. This is really the core dynamic of any company's financial position.
Okay, so this begs a pretty critical question, right? How do we connect what's owned with what's owed to figure out the true value that actually belongs to the owners?
Well, that connecting piece, that bridge between the two, is equity. Think of it as the residual interest. It's what's left over for the owners after you've paid off all the liabilities from the assets. So at the end of the day, equity is the owner's claim on the business. It's their slice of the pie.
All right, now that we've got a handle on these first 3 elements, assets, liabilities, and equity, we've arrived at the most fundamental, the absolute bedrock formula in all of accounting.
And there it is, the accounting equation. Assets equals liabilities plus equity. Now this isn't just some suggestion, it's an unbreakable rule of the universe in accounting. This equation has to balance, always. It perfectly shows that everything a company owns is financed by one of 2 things, either what it owes to others or what the owners themselves have put in.
But a business isn't a static photograph. It's a living, breathing thing. It's always changing. So now let's look at the elements that actually create that change, the ones that describe a company's performance over a period of time.
First up, we have income. This is any increase in economic benefits, like the revenue you get from selling a product. And here's the crucial link. Income increases profit, which in turn increases the owner's equity. It makes that equity part of the equation bigger.
And of course, the counterpart to income is expenses. These are just the costs of doing business, paying salaries, covering the rent. Expenses are an outflow of resources, and you guessed it, they reduce profit and therefore they reduce the owner's equity. They make that equity slice smaller.
So right here you can see that push and pull in action. Income makes equity go up, so the owner's claim grows. Expenses make equity go down, causing it to shrink. And that all-important difference between the two? Well, that's your profit, or your loss.
Okay, we've made it through all 5 of the core building blocks. So let's pull everything together for a quick recap. And here they are, all in one place. You've got assets, the resources you own. Liabilities, the obligations you owe. Equity, the owner's slice that's left over. And then you have the 2 dynamic elements, income, which makes equity grow, and expenses, which make it shrink. Honestly, you can think of this table as your ultimate cheat sheet for understanding any financial statement.
And this, right here, is probably the most important point of all. These 5 elements,
They're not just accounting jargon. They are the fundamental language of business. Once you understand them, you can pick up the financial statements of any company and start to read its story.
Which kind of leaves us with one final thought, doesn't it? Now that you know the words in this language, how do you put them together to read the full story? How do all these elements work together on the actual financial statements to reveal a company's real performance and its overall health?
Hey, if this breakdown helped you get a better grip on the building blocks of finance, do us a favor and hit that like button. And of course, make sure you subscribe to the Audit Guidebook channel for more professional audit and accounting insights just like this.
Thank you so much for your time and for watching the Audit Guidebook channel. We'll see you in the next module.